Now let's welcome on board Devina Mehra and chat about what she's making of the market. Devina, hi, good morning. And firstly, congratulations once again. What a resounding success your book has been. Money, Myths and Mantras, gone into a reprint.
Thank you, Sakshi. Yes, it's been very, very gratifying that, here's the book, that it was, first of all, to get to number one overall on Amazon and then to go into a reprint within weeks of its launching, because a lot of people told me that bookshops in their city had run out. So that's been very gratifying. And of course, for today, the markets also are for once not giving any palpitations to people.
They've done that enough. We could definitely do with some break. But Devina, this is Aisha here. So let's talk about, a theme from your books. Where is there money to be made in this market? Where do you think is still the myth that this sector is going to do well, but do you think fundamentally it's shaken off and it's not going to perform? Let's break it down for our viewers.
Okay, so my advice, Aisha, actually has not changed in the last few months. It's not as if after the market corrected, I started saying something different. So even I had retweeted my July tweet where I had said, get out of small and micro caps and very fashionable sectors and get into a large, steady portfolio. So that pretty much remained. Of course, now, there's been carnage on some stocks. I mean, this is not the latest data, but about 10 days ago, I had looked at the data. And at that time, I had seen that while the index fall didn't seem quite so substantial, we had this thing that the stocks, there were 65% stocks that were down 25 to 50%, and another 19-20% that were down 50% plus. So 85% of the stocks were actually down more than 25%, which was not really getting captured in the index data. So that's why the blood on the street in some fashion has been a lot worse than what appeared. When you just looked at the index, because the index movement is nothing out of line. If you go back 18, 19 years, every year the index corrects in double digit, barring I think 3 or 4 years. And one of those years was 2023. So in a sense, after 2 years, you had a double digit correction, which should not have caused so much anguish. But what people forget, again, this is data I've been pointing out for a very long time, that small cap movements are always very dramatic. If you look at 2008-9, the small cap index fell nearly 80%. And then if you remember, that index came back in 2016-17, but that was theoretical because that index churns 18-20% every year. So 8 years later, it has a completely different set of stocks. And there was another mad bull run in 17-18, and then that index again corrected 2/3. So last year, when I was telling people that, I was told you're being too conservative, and why do you say risk management first? And now the thing is there for everyone to see, because the problem in small caps is that risk management is not possible. When they fall, they just fall like a stone. You can't get out. You can't hedge because there is no liquid hedge on small caps. So, but a lot of the pain is behind us. But remember, in every bull run and then a correction or a fall, the next bull run, the same stocks don't go up. So I would still say that be in a steady portfolio. Below that, it is a very stock specific market. So, grit your teeth and take the losses, even if you are down, whatever, 30, 40, 50% on certain stocks or more, because the stocks may not come back at all, and you don't need to make the money back in that same stock. I always say the market has zero interest in your purchase price. So if a stock or a strategy or let's say a thematic fund has not worked out, it might still be a good idea to book losses and get into a better portfolio.
Well, so much food for thought, but let's first pick it up from what you were talking about earlier, that it's not going to be the same leaders which will make a comeback. That said, Devina, do you think the pain is behind us? And are we now ready and geared up to make a significant comeback? Do you think the selling is done to begin with?
So again, as I said, I always look at it in kind of two categories. So the large cap kind of category, I do not see the risk of a big downside from here. In fact, I would say the risk now in sitting it out is missing an up move, because we all understand the risk of being in the market, that you can lose money, but the risk of not being in the market is that you miss out on an up move. So for some time, I've been saying that if you were waiting for a correction to invest, have you invested? Because this is for whatever is your equity allocation, it is time to be invested. Of course, I always say never have 100% in equity, because equity is money you should not need for 8 to 10 years. But this is definitely time to be invested in equity, whatever be your equity allocation. And this is data I probably would have given in one of my earlier interviews and on your channel, that in 45 years, if you miss out on the 10 best days of the market, you miss out on 2/3 of the return. So if your 100 rupees had become 75,000 rupees, if you miss out on 10 best days, it would only be 25,000 rupees. And the other thing is that these best days come when there is fear and uncertainty, when people are asking questions like, should I stop my SIP? They don't come in a mad bull run. And also academic studies across the world. I mean, this is not just one or two markets, but every single country where that study has been done, it is that sentiment is a contraindicator. When there is fear, anxiety, uncertainty, that is when the next period returns are above normal, when everything looks very good. And as was the case in 2024, when people are saying, I'm conservative and I want only 35% compounding, that's when the next period returns are below normal. So that's the nature of the game. So manage your risk, choose stocks carefully, but it's time to be invested.
All right. Hi, Devina. Good morning. This is Shrishti also joining in. But Devina, a lot of concern related to the tariff concerns were also trickling in, at least for the Indian markets. So, well, of course, on a YTD basis, if we see, then Indian markets have, of course, actually underperforming the rest of the world. But give us some sense there. Is the fear and uncertainty around the tariff concern is overdone now? What is your view on this?
We look at very narrowly at the Indian market, probably, but I mean, Trump is a wild card. Much before he took office, when he was elected in November, I had done a piece for Economic Times itself, where I had said that all the people who are predicting what would happen to markets or inflation or anything or geopolitics across the world once Trump takes over must be drinking something, because this is a guy who's so unpredictable, and a lot of what he said in the campaign was self-contradictory, that you don't even know what he would do. And so the second and third order effects are who can say? And plus you have compounding Trump with Musk, which is also I'd written about, that if you wanted to increase uncertainty, there is no better combination than Trump with Musk. So having said that, I mean, most of his tariff, see, India is not a big exporter overall. And pharma, which is where the tariffs have been talked about as, on one hand, he's saying that costs for the average American are very high, and healthcare cost is definitely extremely high in the US. US has the highest spend on healthcare and the worst outcome among all developed nations, more or less. So if you increase, and India is a relatively inexpensive supplier of drugs. So I don't, see, this is all the way he's using tariffs are as negotiating techniques. And India is basically given in on most of the things he's asked for anyway. So I don't think, on a persistent basis, there are, as I said, there are only one or two sectors which are anyway exposed to the US. I mean, though I have to say that we are overweight to both IT and pharma as we speak in our PMS. So, I mean, obviously we are making the call that this is not going to be a very long-term or very damaging concern.
Thanks for that
what
thought.
Trump does to the world order is the part I'm concerned about, that this whole stability and peace which kind of reigned. Of course, there were many disruptions to it post World War II. What happens to that?
Absolutely, Devina, all eyes are going to be on what Trump does because, like you said, it's very unpredictable. Morning, this is Snehi also joining in the conversation. I'm taking a look at your portfolio, and two names are standing out to me. ITC and AkzoNobel are looking interesting right now among your top 10 holdings. Help me understand, is this how you would prefer to play the consumption space even going ahead? Because we are hearing positive commentary coming in from pure play FMCG players. Do you believe the recovery is underway and is good enough now for you to revisit how you would like to play the consumption space? And do you believe that when the recovery in consumption does come through, it will be the FMCG players leading it from the front, or do you believe it's going to be consumption, broader consumption names like paints, retail, footwear, fashion, all of those?
Yeah, first of all, the consumption, suddenly there's been a lot of hand wringing on it in the last, let's say, about 5 months when the market started correcting. But I had been talking about it a lot longer simply because the consumption actually slowed down in 23-24. The 23-24 consumption, private consumption number in the GDP was at a 21-year low. It was around 4%. This year, it's expected to be 7.5% or so. So, I mean, there was never really a slowdown this year to start with. On the margin, what is also helping is that now food inflation is coming under control, while oil is still quite, the year-on-year increase in edible oil is still high, but most of the other components like the cereals and the vegetables, those things are easing. And on the margin, yes, that helps the FMCG players. As far as we are concerned, we are overweight IT, pharma, auto components. And in the last couple of rebalances, we have added selectively some FMCG names. I'm not sure whether we'll be overweight yet or not, but we've definitely added because our systems have started to like those a bit more. Paints, no, we are still not particularly happy with the paints, or for that matter, reality, which may well, of course, have a reflexive relationship with the markets, that when markets were buoyant, people had money to buy these luxury homes and maybe they don't have now. So that's broadly. So we've added FMCG names. We've also selectively added some chemicals. So while we may still be underweight, we've added some banks. But we look at everything from base zero every quarter. So this is not like anything like a 2-year call or anything. But yes, on the margin now, I think you will see better results from FMCG.
Interesting. Also, Devina, the other thing that you were talking about, right? I mean, no one knows what's going to really happen with Trump and what he's going to say about tariff and how much to which country. But assuming the tariffs are coming, that's not going to be good for even US growth, right? At a time like that, and one can already see some shake-offs coming in the US equities. What happens to India equities in that case? Or do you think the FPI, FII money will find its way to markets like China and India, perhaps?
The US growth, yes, I see, you already see inflation is high, consumer confidence is dropped. So, I mean, when you have all this uncertainty, every day a different announcement, it shakes up the confidence. While the payroll number is coming tonight, but the advanced, some of the other statistics show that labor market, which actually had remained buoyant all through, might also be easing a bit, not so good anymore. And just, no one likes uncertainty, not the citizens, not the markets. And also US, there has been, this is something we had been watching for a while, because US has been a big outperformer overall, barring 1 or 2 years in between for 10, 12 years. And emerging markets have really underperformed over this period. And we always had this on our anvil that at some point that trade will change and US will start to underperform. We thought it was still some way away, but all the shenanigans by Trump make us feel that maybe that time is closer. I mean, Europe, for example, has been doing very well relatively off late. And maybe, now money will look for places outside the US, which means other developed market as well as the developing markets. But I'm not a ever a fan of saying that this is where FIIs will come or when they will come, and that's going to be the market driver, because data doesn't show that. Yes, this time it has been coincident that the FIIs have pulled out money and the markets have fallen, but over a period of time, that unsaid assumption that FIIs come in, the market will go up, FIIs pull out, the market will go down, doesn't hold if you look at the data. But in any case, as I said, maybe the outperformance of the US, that ending of that period is coming closer.
All right, Devina, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us this morning.
Thank you.